morning, everyone. Thanks for going. So I work at Wealth and Investment. I sit on a number of investment committees. The purpose of those really is to come up with a view on risk. How risk on or risk off should we be with our clients' funds? How aggressively should we be investing across the globe and in South Africa? And in order to come up with those views, we have to have an understanding of what's happening for the global economy. Is the Fed going to hike? What do we think is going to happen to the dollar? What do we think is going to happen to inflation? So what I'm going to do here is run through some of the inputs and outputs of those processes. We've catered it in such a way that it is hopefully relevant to the audience. And we're going to focus on the bits that drive transport in general and drive growth in South Africa. And the reason we're going to focus on growth is this chart over here. And this is going to be a set of charts. I'm going to apologize in advance. We'll try not to be death by PowerPoint, but there are a couple of pictures that we need to show. What this chart shows is from 2008 through to now, the changes in GDP each quarter, gross domestic product, compared to the change in the volume of goods that's transported on roads in South Africa. It's data available from Stats SA. They make it all available. And it's an interesting chart because it's different from what we see in most other countries. And what you can see is typically when there's an increase in growth, there is a pretty sizable increase in the volume of goods transported on the road. That's no surprise. What is a surprise is that sensitivity is well above 1. It's about 1.6 times. So a growth of 1% in the quarter, the volumes go up by 1.6%. Equivalently, when growth goes down, you get a big knock through to road transport as well. Most other countries, the sensitivity is around 1 or a bit lower because there's other things in GDP that are not necessarily linked to road transport. Especially in developed markets, you've got a large part of services and IT and that sort of stuff, which isn't particularly relevant. So the first question is, why are we above 1? It's not immediately clear. It's probably linked to taking market share from rail. That's probably a large part of it. But nonetheless, it is clear that it is a large sensitivity. Now, going forward, will it still be 1.6? Probably not. We'll probably trend to what we see in other countries, a sensitivity of around 1, maybe lower. But even a sensitivity of around 1 means GDP growth is the primary driver of transport volumes. If volumes go up, if GDP growth goes up, volumes go up. If GDP growth goes down, volumes go down. So what we're going to do now is we're going to wind a little path around the globe and land up back in South Africa to try and get an understanding of what's happening to South African growth and what we think is going to happen to South African growth over the coming year or so. We'll start off with what is happening in Russia and Ukraine because it is completely relevant to the situation at hand, primarily through energy prices. The chart on the left is the price of WTI oil. It's the price of oil in the US. It's a very similar series to Brent. To all intents and purposes, it is the same. And you can see how it's been trending up over time because of recovery in global growth. It's completely normal as you see in economies across the globe recovering, increased demand for oil because of more transport, prices go up. Fine. Then Russia invaded Ukraine and the price of oil went from 100 up to 120 or so. Subsequent to that, there was a bit of a slowdown in China because of another wave of COVID. We saw some prices come back, but now they've got back to where they were, at around $120 per barrel, there and thereabouts. That itself is problematic. Spend on fuel across the globe is around about 4% of most CPI baskets. Central banks don't enjoy it when CPI goes up. If CPI is going up because of higher fuel prices, you get a risk of what we would consider a policy mistake. Central banks get hike rates because of higher fuel prices. So you hit consumers on both sides. Now that's the sort of stuff that's happening now across the globe. It's happening in South Africa. Our story is a little different. We're going to come to that now. But it's happening abroad as well. It's actually a little worse than this, though. Because at the same time, there's a refining shortage across the globe. So fuel prices have gone up. Oil prices have gone up. But gasoline and diesel have gone up by even more globally. And that's also due to the Chinese lockdown. There's a lot of spare global refining capacity in China. They shut down the economy, their capacity gets taken out, and then you land up with a situation where diesel prices across the globe have ramped up. Now this is a very problematic scenario for the global economy. If this persists or deteriorates, we will land up pushing some countries into recession or landing up with very low levels of growth. Fortunately, the cavalry is on the way, although it may take a little time. This is the number of rigs, oil rigs, land-based oil rigs in the US, in Texas, the Permian Basin. They frack, they go set up a rig, and they go and extract the oil. You can see how this has been trending up over time. That's crude oil production out of the US. It's up 300,000 barrels per day since Russia invaded Ukraine. So already we're starting to see more oil hitting global markets. OPEC has said they're going to increase production by 650,000 barrels per day. So all told, between those two, we're already at 1 million barrels per day more oil in a month or so's time relative to where we were in February, with more on the way too. The marginal cost of production for an oil well in the US is $60 per barrel. That's how much it costs to go and sink the well and get this oil out. When oil's at 120, it's a massively profitable enterprise to go and drill more. So we can expect this series to continue to pick up, and therefore we can expect more oil. How long will oil remain at 120? I don't think we're brave enough to make that call. I don't think anybody can make that call with any degree of certainty. But what we can say is, as long as it is at that sort of level, there's a huge incentive for more production. That production will come, and the trend over the next year, it may take a while, should be down rather than up. The reason it's significant, aside from it being an input cost, is that it matters for inflation. This is what's happening to inflation for the 50 largest economies across the globe. We track them all. The median inflation rate at this point for those 50 economies is 8%. Okay. Higher than what we've got in South Africa. We're at around 6%. It's not often the case that inflation in South Africa is lower than global inflation. The last happened in 2004. The rest of the globe has an inflation problem that we don't have at this point. They already are suffering. And it increases the level of uncertainty, because we haven't seen global inflation like this in at least 40 years. So we don't know how central banks are going to respond. There are very few people working at central banks that have actual experience of inflation rates like this. When inflation is 3 or 4%, we know how Jerome Powell will react. When inflation is 8.5%, we don't. Same with the BOE. Inflation in the UK is 9%, by the way. And same for the ECB. So it increases the level of uncertainty. It makes it a bit more difficult to get a handle on where growth is going to be, because we don't know where interest rates are going to be. But here again, the cavalry is on the way. There's good reason to believe that the direction for inflation globally at this point is down, not up. And there are a number of different reasons for that. I'm going to highlight a couple. But first and foremost, this is the cost of shipping goods across the globe. This is an average of the major shipping routes. So Shanghai, Rotterdam, Shanghai, New York, Shanghai, LA, Shanghai, New York. We've got about 10 of them that we take an average of. And the cost of shipping a container, on average, across all those routes, went from about $2,000 up to $10,000 during COVID. Absolutely ramped up. This was the whole supply chain mess that everyone's made reference to across the globe. I'm sure a number of people in this room would be painfully familiar with what's happening here. But note how it started to roll over. It's down 25% off its peak. In fact, the cost of shipping goods between China and Europe is actually down year on year at this point. So it's gone from being an inflationary support or support for inflation to a disinflationary or actually deflationary support. It's pushing inflation down across the globe at this point. And that's despite the fact that fuel prices have gone up. And the background to this is around this point over here, there were a whole bunch of checks that went out in the US. So consumers got all this free money, they went out and spent. Amazon, Walmart, they weren't ready for it, so their inventories got absolutely crushed. They had to go and order stuff from across the globe. China exported, the US imported. The shipping industry wasn't able to be flexible enough. It takes a long time to get new ships and containers, so prices ramped up. But now, if you look at inventories, Amazon and Walmart, or US retailers in general, their inventories are in line with pre-COVID levels. So they no longer need to stockpile. That pressure on supply chains has been taken out, so costs are coming down. There are a number of other reasons to believe that inflation is rolling over too. If you look at used car prices as an example, they've been down for 3 of the past 4 months. That's 4% of the basket. And there are a few other series as well, goods prices that are rolling over quite aggressively. And as a result, we think now, this last print that we saw this yesterday, is peak inflation in the US, and we should start to see those numbers improve. That's not going to prevent the Fed hiking. This is the number of hikes, number of 25 bip hikes that's expected at each upcoming FOMC meeting compared to the interest rates. Basically, the Fed is expected to hike by 50 basis points next week on the 15th of June, then another 50 basis points in July, and then another 50 basis points in September. That's what's currently expected by the market, so brace yourself, because the Fed is likely to do something similar to that. They'll probably do 50, 50, and at this point, maybe not 50, maybe this is 25, maybe they hang fire, but they're definitely hiking. And when the Fed is hiking, central banks across the globe have to hike too. So we can pencil in the SARB hiking as well. Just bear it in the back of your mind. The background is an environment where inflation is still high. It's starting to come down, but it's still uncomfortably high for central banks. They need to protect their credibility, especially outside of South Africa. Less so here. So they're going to hike. And we will hike because they're hiking. Switching to China. China is pretty important for global markets. And there's been some pretty worrying data out of China linked to their COVID situation, the zero COVID policy. The most worrying bit has been these two charts. So the chart on the left, this one over here, is the cost of borrowing for sub-investment grade and investment grade corporates in China. If you are a sub-investment grade corporate in China, junk rated by the rating agencies, and you want to borrow in dollars, it will cost you 20% at this point. That's the line up at the top, and you can see how it's ramped up there. It is penal, it is excessive. Nobody wants to lend to a sub-investment grade Chinese corporate. And the reason that's significant is if companies don't have access to cheap capital, it means lower growth going forward. But we don't really concern ourselves with sub-investment grade Chinese corporates. We don't invest in those companies, they're less significant for growth. We concern ourselves with investment grade Chinese corporates. And here you can see the cost of borrowing has gone up too. It's now 5% in dollars. Now it's been 5% before. 2018 was 5%. That's not really a problem. But if it gets to 6 or 7%, then the cost of funding for investment grade corporates in China becomes too expensive for them to sustain their current growth trajectories. So if this line gets to 6 or 7, then we have to say Chinese growth is going to roll over. And it's not going to be 4% for this year, it's going to be 2%. And if Chinese growth is 2%, we're in trouble. So basically, this is the series that we watch most intensely. This series, if it gets to there, then we get worried. Chinese retail sales, the last numbers for April, they were down 13% year on year. It's terrible. They were like that because they shut down the economy. Right? We saw it happen before, the last time COVID was around. So you just look at that and you say, you'd be quite concerned. You'd say, like, the globe is in trouble at this point. We are now facing an issue where the Chinese economy is slowing because of higher costs of credit, and they're slowing because of shutdowns. Brace yourself. And there are a number of market commentators out there penciling in pretty low numbers. Expectations of growth of 2% for China. We've seen that from some of the service providers we subscribe to. But again, there's some cavalry on the way. And that is credit extension in China, which is at this point growing very rapidly. This is what's known as a credit impulse. When it's high, credit extension is picking up, growing very rapidly. When it's low, it's contracting. Around August last year was the low. It's been picking up since. This is the key leading indicator for economic growth in China. And it's been picking up because the central bank is stimulating. The Fed is hiking rates, the SARB is hiking rates. In China, they're cutting rates. It's a different story. They're reopening the economy. As of Monday last week, Beijing reopened. They're allowing people to back on public transport. Shanghai's got a temporary shutdown for this weekend again. Point is that they're reopening and they're opening the floodgates for credit. So what happens then is that people get out and about with pent-up demand and they simultaneously get access to credit. So there's a lot of concern around China. We're a bit more relaxed because what we think is going to happen is over the next 2 months, you're going to see a boom in domestic Chinese demand. People that, just like us before, were locked up, get out there, and we're going to go spend. Okay, on to South Africa for the remaining 10 minutes, and hopefully I'll have some time for questions as well. There's no shortage of pessimism with regards to the outlook for the South African economy. I think that's pretty traditional. But we do need to recognize that the South African economy has been surprising by more than nearly every other economy globally. And not enough attention is placed on that. Last year, as an example, the South African economy grew at 4.9%. A year and a half before that, the expectation was to grow at 2.8%. So we surprised last year by 2.1% relative to expectations. We surprised by more than nearly every other economy out there. It was great for the US, they surprised by less than us. It was great for the UK, they surprised by less than us. Same for Europe, they surprised by less than us. China surprised by less than us. We surprised last year by more than everybody else. And this means that growth surprised by more than everyone else. This means that road trade volumes surprised by more than most other countries. So we have to ask ourselves, why were the expectations so low? And is it the case that we're going to surprise again over the coming year? Well, the first thing we have to notice is we've done much better than expected from a growth perspective. These are the GDP numbers which came out last week. This is real GDP. This is a volume number. Real GDP is now back in line with pre-COVID levels. At the time of COVID, at this point over here, everyone was saying that the South African economy would only get back in line with pre-COVID in 2024. Okay, we've done so in 2022. No one expected this ramp up in growth in South Africa. By no one, I mean the SARB, Treasury, the IMF consensus. There wasn't a forecast out there that said that we would get back to pre-COVID levels of growth of GDP before 2024. That's the volume number. This is the value number. You can see we've absolutely ramped up. This has been a very strong period for growth in South Africa. The recovery has been swift, and from a value perspective, it's well above pre-COVID levels. Why has that been? We're lucky. We happen to produce the commodities that the world needs at this point. This is our net exports over the rolling 12-month window. At this point, the number's around 400 billion rand. It's around 8% of GDP. The last time we were exporting like this as a percentage of GDP was the late 80s. We haven't seen anything like this in 30 years. To put that in context, net exports for Saudi Arabia ahead of COVID was 9% of GDP. Right? They're a massive exporting nation. Ours is 8%. Okay. We are exporting like Saudi Arabia. Huge exports going out of our ports. The volumes are no different. It's the price that just happens to pick up. And so our trade surplus has been vast. What that means is mining companies are making a lot more money, they're paying a lot more tax, the government gets a lot more tax revenue, they can pass that on through reductions in personal income tax, which in effect is what we saw in February. It means government doesn't have to borrow as much, so it reduces some of the pressure on the economy that way too. This is massively significant for the South African economy. This is the reason why we've been surprising on the upside. But the market and the IMF and everybody else you talk to says, all right, well, this line's going to zero, boom, and then we're going to disappoint again. It's somewhat unrealistic. Our belief is that commodity prices, the ones that are relevant for South Africa, remain elevated for some time, partly due to sustainability issues. What's happening across the globe is this massive shift towards renewables, away from hydrocarbons. So you want wind and solar. That's very metal intensive. You need a lot of commodities to do that. At the same time, mining companies can't drill and dig deeper holes in the ground in the way that they did before. Take lithium as an example. The lithium price is up 6 times over the past year. A mining company goes to open up a lithium mine in Chile. The community says, no, you're going to pollute the river, we don't want it. They're within the rights, no problem. But it means that we've emphasized protecting local communities, reducing local pollution, and we're not allowing enough material which is going to address global pollution. Anyhow, the net result of this is that mining companies aren't increasing production very rapidly, but demand is going up. Great for commodities, great for South Africa. What could hold us back there? Well, we could hike rates massively, put ourselves into recession. But this is South African inflation relative to global inflation. As I mentioned earlier, we're not particularly elevated. Our inflation rate's around 6%. The global median is 8%. What's going to happen to inflation in South Africa? Well, we did hike the petrol price by a significant amount last month. We modeled inflation. It'll probably get to around 6.5% at its peak, and then it'll start rolling over again, just like it's rolling over the rest of the globe. So we're not too concerned on the inflation front. We don't think it's going to get to 10%. It's not going to get enough where the SARB has to hike to put us into recession. The market has a different view. What's currently priced in is for the SARB to hike by 10 times over the coming year. 250 basis points, they're going to push rates up. That's what the market says. We're somewhat more relaxed. They probably will hike over the next few meetings. They will do so, as I say, given the global environment, they've got a little option. But they're not going to do this. But again, the IMF, the SARB, everyone else says that what they're pricing in is the current environment, commodity prices will roll over, the SARB will hike, and then growth for South Africa will be weak again. Just another data point that's quite interesting. This is employee tax receipts. We could look at the SATA unemployment data, but that's a survey-based number. We rely on hard data. We prefer to rely on hard data, so we can go get the tax numbers. Nobody wants to pay tax. If anything, income growth is probably faster than tax growth, because there would have been some money that's not been reported. Employee tax receipts are up around about 10% relative to pre-COVID levels. Incomes in South Africa have recovered. We can see it from the tax that we're paying. We wouldn't be paying this amount of tax after a tax cut if incomes hadn't recovered. And we can actually see this through the retail sales numbers, which have been very good. We can see it through the banking data as well. The South African economy has recovered. We can see it through every piece of data that we look at. South Africa is not without risk. We need to be cognizant of that. This is the energy availability factor for Eskom, which is the percentage of their fleet that's available for production at any point in time. And you can see the worrying trend each year goes down. It's currently at around 60% or so. For electricity to not be a binding constraint on growth, it needs to be at around 75 to 77. So electricity clearly at this point is a binding constraint on growth. And it will be for the next 12 to 18 months at least. I mean, people will shift away from Eskom. We're seeing a lot of that happening, and at some point they'll be able to service their clients, and we'll be away from this problem. But we've still got another winter or two at least of this being an issue, which means that the South African economy this year will grow at, say, 2.5%, not at 5%. But that's still more than is widely expected. And that's what I want to have as my last slide before we open up for questions. This is what is currently expected from all the major institutes across the globe compared to what will happen if we don't grow at all for the rest of the year. So the IMF, at their last update, which is in April, they said the South African economy is going to grow at 1.9. Treasury said 2.1, the SARB said 1.7, the consensus forecast is 1.9. If for the rest of the year, after Q1, because we've got the Q1 numbers, so Q2, 3, 4, we grow at 0 every single quarter for the rest of the year, then growth this year is going to be 2.4%. So every one of these houses must implicitly be saying that the South African economy is going into recession for the rest of the year, for their numbers to be right. It doesn't seem very likely given everything that we've just looked at. What's going to happen in our view over the coming 6 to 9 months is just like last year, all of these numbers have to be revised up. Expectations for South Africa are too low. And it's not like we're saying we're going to grow by a hang of a lot. We're talking 2.5%, maybe a bit more, 2.6%. But that is still massively more than everybody else is expecting. And if we do 2.5% up to 3% or so, it means that government revenue will surprise on the upside again. Last year it surprised on the upside by 200 billion rand. It means that debt to GDP will be better than it was last year again. It means that top lines will be better. And lastly, the point I'll end with, it means that road freight volumes will be better as well. So that's where I'm going to leave it. Bongani, there's 1.5 minutes. I'm not sure that's enough time for questions.
Well, let me start with what is the last question on my slide, but I think it speaks to the point you've just ended off on. And it says, as road transport sensitivity to GDP is high, is the reverse also the case? Meaning if road transport starts to fail, what will the impact on GDP and SA economic growth be?
That's a very difficult question to answer, and the reason I say that is for most of these sort of analyses that we do, we can simply have a look at what happens to one sector versus another, and you draw a line between the two. But when something is as critical as transport, there's non-linear impacts. So what happens is transport cuts out, you say, all right, transport is 5% of the South African economy. So if transport stopped, GDP would drop by 5%, but we know that's not true. You get an outsized reaction. So for sort of small moves, there's a linear relationship. Yeah, it matters. But for a large move like that, if you're talking about a shutdown, the knock-on for the SA economy, you can't easily model, but we do know that it would be massive.
Perhaps let's squeeze in one more, and it says, how does the South African fuel price compare with the rest of the world based on the tax or levy portion in the price, excluding the world oil price? And can the economy carry this tax burden?
Yeah, we're about middle of the range. I know it doesn't feel like that. Our prices are not materially different from some parts of the US. They do it price per gallon, and in some parts of the US, you're looking at $5.80. One of my friends in Chicago, he took a photo and sent me. And we're about that. Dollars per gallon, we're about $5.80 at the moment. Norway is $10 per gallon. Okay. So they're close to 50% more. Venezuela is a cheap end on the other side. They subsidize it. They're less than $1 per gallon. In that whole range, yeah, we're about in the middle. Less than Europe, more than most parts of the US, more than countries that subsidize, but yeah, pretty standard levels of tax. Great. I will be around for tea. I know I didn't leave a lot of time for Q&A, so if anybody's got a question, feel free to grab me there.